Hi, this is Sean Hyman from MyWealth.com. I want to talk to you today about 3 reasons why I believe that this dollar rally is really a phony and it's really what I call a bear market rally. So let's go ahead and get started and I'll explain to you why.
Be sure to check out the written blog at www.mywealth.com/blog. Today's title is Don't Be Fooled by the Dollar's Recent Rally. Now, why would I say that? There's 3 main reasons why I believe that the dollar is simply in a bear market rally right now. Number 1, the technical outlook on the charts is just horrendous. Let's take a look at the downtrend on the next slide. This is a chart of the dollar index, which is the dollar versus 6 or so other currencies, and it gives a broad outlook on the dollar. And for those of you who know technicals, this paints a very bad picture. Anybody who even doesn't know technicals, just following the price, can see that it went from the lower left to the upper right, peaked in March, and has been heading downward ever since with lower highs and lower lows. It's a technical definition of a downtrend, but also you have it below 2 lines there that you see on the chart: the 50 simple moving average and the 200 simple moving average. Even those moving averages crossing, with the 50 going under the 200, another bearish sign, and the price trading below both, another bearish sign. Under that, you have the first little squiggly set of lines that you see underneath the price chart. It's called a slow stochastic, and this is has almost reached another sell or overbought signal, which again is technically bearish. And then you have the very bottom indicator where I've drawn the long red arrow is the MACD indicator, which is produced lower highs and lows, and even more importantly is trading below its 0 line, which is where those red bars flip from positive to negative. And that basically acts like an ankle weight, if you will, on a currency. And so all this combined really shows that the dollar is in fact in a bear market. And this is why I call it a bear market rally, because even bear markets have rallies upward. It's just that the next high will be lower than the previous high. And so that's why I've drawn the chart as I have in a little bit of a scenario that can show where the dollar could go. Of course, it could drop right from where it's at right now, but also another scenario is it could rise a couple hundred pips or so, as shown by the green line, and then drop, shown by the downward red arrow on the chart. So the technical picture is one of the biggest things to keep in mind. There's old Wall Street adages that say don't fight the trend, don't buck the trend, trade with the trend, trade the trend till it ends. All those adages over time, they've come about because this is really the high probability scenario. You shouldn't say what should a currency be doing, but really what is the currency doing, and then trade in line with that, assuming it continues until it ends. Okay, reason number 2, a lack of inflation in the U.S. Oh, there's inflation in some places in the world, don't get me wrong, just not in the U.S. Therefore, there's no reason to raise interest rates at this point in time, so there's no reason for money to be attracted to the U.S. dollar right now. This can be seen on this next slide, and you'll see where inflation is. I mean, New Zealand has 3% year-over-year inflation, being the top inflationary area in the industrialized world, followed by Australia, 2.5%. the UK, etc. So these 3 areas really do have quite a bit of inflation. There's a little bit of inflation in the Euro area and in Canada, and then after that it quickly goes negative to Japan, the United States, and Switzerland. So you can see the 3 places where inflation is not. So when you have negative CPI, it stands for Consumer Price Index. When you have negative consumer prices, it means the prices of goods and services in those countries are actually falling, and so it shows a lack of inflation in those areas. Well, when there's a lack of inflation, it doesn't need to be fought by higher interest rates. Remember, money is attracted to yield, so it likes higher interest rates. So the thought is, you want it, from a currency perspective, you want to see inflation rearing its ugly head. You want to see central bankers have to come in and fight that inflation by raising interest rates, because you know that money will be attracted to higher yield over time. We're seeing the exact opposite case for the U.S. dollar right now, so there's no case for a dollar rally. Now, reason number 3, negative dollar sentiment. This one's a huge one too. Currencies are very sentiment-driven instruments as well, and why is there a negative sentiment out there? Well, Obama's got a very anti-capitalism policies that are going on out there. They're horrible for growth and expansion. It's almost socialistic in nature. There's more money printing by the Federal Reserve. And what does that do? It dilutes the value of the dollar over time. Anytime you have a overabundant supply of anything, the value of it goes down. That's just anything in life, but the dollar included. And the enormous debt that the U.S. has incurred in the past year or so. You've seen it on the nightly TV of just how it's stacking up tremendously, and that's a worry to countries around the world that normally buy U.S. dollars and normally buy U.S. treasuries. The higher we rack up the debt, the more they get skittish about investing in our currency and investing in our treasuries. So it's a huge problem. But wait, there's more. There's China diversifying some reserves into commodities and buying commodity companies instead of going into even more dollars. Now, I'm not saying that they are selling their dollar reserves. I'm not saying that they're not still buying some dollar reserves. What I am saying is that they're taking part of what they would have bought dollar reserves and treasuries with. They are currently diversifying and using those funds for commodities and buying commodity companies. Why? Well, when the dollar goes down, one of the first things that goes up is commodities, and they're going to have a need for raw materials and commodities in their expansion anyway, so it's a smart move for them. It really is. Bad move for us, smart move for them. Russia and China starting to do some business in rubles and yuan, which circumvents the dollar. Again, this undermines the dollar because they're going around the dollar and dealing directly with each other. Again, not 100% of their business is this way, but it's a start. And when you see a trend start and them push in this direction, it's not a good sign sentiment-wise for the dollar. And even though some of this trading will take time to get started, the sentiment from it can start immediately. Brazil and China starting to do bilateral trade in yuan instead of dollars. Again, circumventing the dollar, not a good sign there either, not good for sentiment. Russia may ink a deal with China to buy their oil in rubles rather than dollars. Now, it's estimated that they're going to need about $100 billion worth of oil over the next 20 years. That's no small sum. But if they didn't do that in dollars, if they didn't purchase dollars to buy that oil and they were able to purchase rubles instead, it would be very supportive of the Russian ruble, very bearish for the U.S. dollar. So again, a huge one there. Who could be a huge beneficiary? Actually, several of those nations that we talked about that had high inflation. But to me, the number one pick in my book fundamentally is the one country right now, the one industrialized country that has positive GDP growth. It has the inflation. It has the high interest rates. It has a fairly low jobless rate in comparison to most other nations out there, is Australia. That's AUD/USD. Now, I'm not saying that Australia will not decline some more in the near term from here, but you can see ever since March, since the dollar started its decline, the Australian dollar has been one of the biggest beneficiaries of that dollar decline, and it's taken off very well. Why? In addition to the interest rates, inflation, GDP growth that we mentioned, the commodity picture that we talked about, and commodities, all the commodity buying from China, that sort of thing. One of their biggest customers that they buy commodities from is Australia. So as this new picture unfolds, Australia will ride on the coattails of this shift, particularly with the Chinese. So the Aussie dollar will benefit and go up over time, as shown by the green arrow. Again, this is just my opinion of the way I see this all playing out. But there could be some near-term pullback still to go, as shown by the red downline there. Okay, want to find out more about us? You can call us at 866-257-9677. You can click on our courses tab at mywealth.com and find out more about our courses. Of course, this being involved in the currency course, but we also have stock market courses. We also have a personal finance course. Everybody needs to have their ducks in a row, actually, in all of those areas. How can you invest in currencies if you don't have your personal finances in order? How can you invest in stocks if you don't have your personal finances in order? So there's all these intermingle. You need to have some stock investments as well as currency investments with your excess money. How do you get excess money from the personal finances being in line? So every last one of these courses, in my opinion, are very, very crucial, very, very important for people to take. And you can get them very inexpensively. So you can reach us by phone, you can reach us on the internet, you can also reach us by email at sales@mywealth.com if you have further questions about our courses as well. But whatever you do, don't wait, get in a course and get educated today at www.mywealth.com.